Hey there, Money Masters. It's your girl Izzy, back with another episode of Money Matters Made Easy. Today, we're diving into the deep end of the financial pool to talk about a topic that might seem a bit intimidating at first: credit derivatives. But don't worry, I'm here to break it down for you just like we always do. So let's get started. Imagine you're a farmer and you've got a big field of wheat. Now, you're not just growing this wheat for fun, you're planning to sell it. But here's the thing. The price of wheat can fluctuate a lot. One day it might be high, the next day it might be low. This uncertainty can be a bit nerve-wracking, right? Well, this is where our analogy begins. In the financial world, the wheat field is like a loan, and the farmer is like a bank or a lender. Just like the farmer, the bank is also worried about the uncertainty. But in this case, it's the uncertainty of whether the borrower will be able to pay back the loan. Now let's say there's another farmer in town who's willing to take on the risk of the fluctuating wheat prices. This farmer says, "Hey, I'll pay you a fixed amount for your wheat no matter what the market price is." This way, the first farmer is protected from the risk of fluctuating prices. In the financial world, this second farmer is like a credit derivative. A credit derivative is a financial contract that allows the risk of default, or the risk that the borrower won't pay back the loan, to be transferred from one party to another. So, just like the second farmer takes on the risk of fluctuating wheat prices, the party that buys the credit derivative takes on the risk of the loan defaulting. But why would anyone want to take on this risk? Well, just like the second farmer is hoping to make a profit if the price of wheat goes up, the buyer of the credit derivative is hoping to make a profit if the loan doesn't default. They're essentially betting on the borrower being able to pay back the loan. Now, there are different types of credit derivatives, just like there are different types of crops. Some are simple, like credit default swaps, which are basically insurance policies on loans. Others are more complex, like collateralized debt obligations, which bundle together multiple loans and then sell pieces of that bundle to investors. But no matter what type of credit derivative we're talking about, the basic idea is the same. It's a way to transfer the risk of a loan defaulting from one party to another. And just like farming, it can be a risky business, but it can also be a way to make a profit if you know what you're doing. All right, Money Masters, that's it for today's lesson on credit derivatives. I hope this analogy helped make this complex financial concept a bit easier to understand. If you found this video helpful, don't forget to hit that like button and subscribe to the channel for more easy-to-understand financial content. Remember, understanding money matters doesn't have to be hard. With a little bit of knowledge and the right tools, you can become a master of your own financial destiny. So keep learning, keep growing, and I'll see you in the next video. Until then, stay savvy, Money Masters.